Trade with Books English channel, and today is the chapter 3 of value investing, where we'll learn that how to calculate the discount rate. In last videos I have explained you, for any company, if you want to measure based on discounted cash flow model, what is the true value of the company. This is the formula, easy formula, where you need four inputs. You need four inputs. First is the discount rate, this R. The R you are looking at the bottom is called the discount rate, which reflects the risk of the cash flow. What is the risk in the cash flow? This is the first one, discount rate, which today we are going to learn in detail how to calculate cost of equity and cost of capital, because cost of equity is the discount rate required when you are valuing a company's equity part only, and cost of capital is the discount rate which is required if you are target to value full company, means equity plus debt. The second input required is estimated cash flow. This ECF, estimated cash flow, is the second input required. And the third input required is the growth rate, means next year what will be the expected cash flow, how much growth is there in the company. And last is the terminal life, like for how many years you can add this cash flow for a company, that is called terminal life. So these are the four inputs required. Today's video you will learn the first input, how to calculate discount rate. In upcoming videos, these all three parameters you will learn, and finally you can value any asset based on discounted cash flow models. So in last video what I explained you, that these are the four inputs, like I explained you: cash flow, the growth rate, the terminal value, and what is the discount rate. With this you can value the whole firm or the only the equity part. We are focusing to value only the equity part because our focus is to buy shares. So if we somehow learn how you can value the equity part, you can judge that what is the current share price and how far it is from the true value. When you are valuing the equity part, the discount rate which you need is the cost of equity. If you are trying to value the full firm, cost equity plus debt, then your discount rate required is cost of capital. That also I will explain how to calculate, but our focus is how to calculate cost of equity. Now what is cost of equity, that we are going to learn. Okay, I hope you understood till now that we are focusing on cost of equity, that is the discount rate, and that discount rate we will use in this formula so that we can get the value of an asset. So let's start. Discount rate, cost of equity for valuing equity part only. We are using a model, a finance model called capital asset pricing model, CAPM model. This is called CAPM model, capital asset pricing model. This is a risk to return model where the cost of equity is equal to this formula, where the RF, where the first one, RF is the risk free rate. This is called the risk free rate. The second one is beta. Beta is relative to market portfolio, and RM minus RF is called market risk premium. In detail, now our focus is to learn what is the value of these three. If we somehow get these three numbers, we can easily calculate cost of equity, and that is the discount rate, which will help you to come to the number discounted cash flow value of any company. So we are going to learn that. So one second, give me a second so that I will arrange this. Okay. Now we are going to the next part where we learn what is the risk free rate. The first one, the risk free rate. This is our focus, risk free rate. So what is risk free rate? When I tell that risk free rate, this is the return which you can make on a guaranteed investment. Now what is guaranteed investment? Think about something like a government bond. That is almost like a risk free, because government will not default, but not all government are default free in the world. So you have to add a default risk in the government's 10-year bond yield rate. Now why 10-year bond yield rate? Because you are taking cash flows for a long period, maybe 30 years, but that 30-year bond yields are not available easily in our government. So we are taking maximum of 10-year bond rate. that is almost like a risk free rate, but there we are deducting a number called default risk. Like for that country, what is a default risk? Now what is this both number? So the first number, government 10-year bond yield rate, is currently 6.44% as per investing.com, and the other one, the default risk, this is the table which shows that what is the default spread based on the rating. These ratings are provided by Moody, S&P. These are the rating agencies. For India, if you see, Indian government currently Baa3 rating is there, which corresponds to 200 basis point, means 2%. This is called default spread. Now when you decrease the 2% from 6.4%, the number comes at 4.4%. This is your risk-free rate, 4.4%. Now you got the first number, risk-free rate. Now the second number is beta relative to market portfolio. What is beta? Now beta tells you that whether a stock is twice as risky or half as risky compared to index. Now think about it, when Nifty goes about 10%, some of the stocks goes 20%. But when Nifty fall 10%, the same stocks falls also 20%. But there are some stocks like ITC and all, which actually moves lesser than Nifty. Like Nifty moves 10%, they will move only 7%. So their beta is 0.7. But a stock which moves twice as index, their beta is 2. So beta value you can easily get in Google. When I write beta value of Tata Motor, it will come 1.4. So it means that when Nifty moves 1%, index moves 1%, your overall portfolio moves 1%, means this Tata Motor moves 1.4 times. So beta value tells you that what is the relation between the overall market portfolio and your stock. So beta value you can get from Google easily. Now the third thing, now we got beta and risk free rate. Now the third thing, market risk premium. What is this? Market risk premium tells you that if someone has all his money in the fixed deposit, then what extra percentage you have to offer him so that he is convinced to put that money in your stock. Okay. So that is the extra alpha he needs so that he will take a decision to take his money from FD and put in the stock. That is that extra equity risk premium. Now how to calculate this number? Two methods are there, either look backward or see forward. So if we see backward, returns on index are always been around 13% CAGR. And the risk-free rate is 4.4%. So equity risk premium is this difference of this both number, that is 8.6%. So if I'll get 8.6% more than my risk-free rate, I will think about investing in that stock. Why? Because if I am ready to invest in that stock, at least it should beat the index, because index itself is giving a CAGR of 13%. That is why ROE number should be more than 13% for any company, any stock, because when index itself is giving 13%, your stock should give at least ROE of 13%. So now we got all three numbers. So with this all three numbers, you can easily calculate the discount rate, the cost of equity, because now we have these three numbers for any stock. Now if beta value is 1, the discount rate will be lesser. If beta value is 2, here if you put 2, the discount rate will be more. So discount rate is at the bottom when you are valuing an asset. So the more the discount rate, the lesser the value of the company. Means the high beta stock, there are riskier stocks, so their value will be lower. The more the cost of equity, the more the discount rate, the lesser the value of the company. It is more risky. So like that you can calculate the discount rate. Now we got to know how to calculate the cost of equity if you are doing a valuing the equity part. Now suppose you are valuing the entire firm. In last video I told you, if you are valuing entire firm, means cost plus debt, then you have to choose the discount rate, that is cost of capital. Now how to calculate cost of capital? This is the simple formula for cost of capital. You have to calculate first the cost of equity, that you have to multiply with the percentage weight of equity part in the company plus cost of debt multiplied by percentage weight of debt. Now what is cost of debt? Cost of debt is the risk-free rate plus the default spread. Earlier we have minus the default spread, now here you have to plus the default spread. So this is called the cost of capital, which you have to use in your valuing a firm. So now we got the first number completely, the discount rate. Now we have still question what is the how to calculate estimated cash flow, growth rate and terminal value. So in next chapter we are going to see how to calculate these three. Then we can value any asset based on this formula. Expected cash flow calculation is nothing but the cash flow, the operating earning coming in the company minus the tax which it has to pay, minus the investment it has to do for growth part, then it has to pay the debt also. The remaining cash is called the expected cash flow. That we'll see in detail, and what is the growth and terminal life. When we will finish this, you will be able to value any asset based on discounted cash flow model. All the best. We'll see you in next video. Consider subscribing. I hope you are liking this. Thanks for watching.